Hi, I'm Jared Dillian. I'm here with Simon Mikhailovich of Bullion Reserve. Simon, we got to talk over the weekend. We did a little bit of a warm up for this interview, um, and you said that you lived in the Soviet Union until age 19. I want to talk about this first because I think it's relevant, just sort of based on current events. Can you just spend a couple minutes talking about your experience, why you left, stuff like that? You said you lived in St. Petersburg.
Yeah, I mean, I was born in St. Petersburg. I grew up there, right on Dostoevsky Street, which at the end of the street was Dostoevsky's apartment. Those were the 60s and 70s. I was born in 59. So relatively speaking, I caught growing up, I guess, the most benign part of the Soviet experience. Stalin was gone. They weren't taking people in the middle of the night. There was still a police state, and if you opened your mouth, you could get hurt. But if you didn't open your mouth, if you said the right things, you could more or less conduct a normal life. But it was a very difficult place to be. I mean, there was, aside from the material discomforts and the difficulty with getting anything, the economy was stagnating. There was absolutely no growth of any kind. People did the same thing year in and year out, same jobs, same places, no dynamism of any kind. Of course, now we know it as the era of stagnation. We didn't know that at the time. And furthermore, a lot of symptoms that eventually led to the collapse of the Soviet Union that I have been observing here and have spoken in some of these interviews, which is loss of faith or loss of confidence of the population in the policies of the government. Loss of confidence in anything they're being told officially, inflation, hidden inflation, lack of growth, lack of opportunity, politically repressive regime. You have to speak, only politically correct things. If you can't disagree. So your whole life is based on two realities, essentially what you can say at home and what you can say outside of your home. And even at home, you have to be careful. And so all of these types of conditions, corruption, official corruption, you have to pay bribes everywhere to get anything, massive regulation, tightly controlled population, all of that put together, it sort of brought to us, to my father and myself mostly, my mother didn't want to go, that there was no future here. I mean, there was no future. The system didn't work. People didn't seem to work. Same like here. Everybody was supposed to work, but you couldn't find workers. And when you found workers, they took the salary, but they weren't doing much. The saying was, we pretend to work and they pretend to pay us. And so, yeah, or they pretend to pay us and we pretend to work. And so it was not like this or that. I know that people think from looking from the West that life in the Soviet Union was like some black and white movie where you woke up in the morning and, you got your, 3 ounces of bread. No, with water. No, it was not like that. My mother made eggs for breakfast and I went to school and we had holidays and my grandparents had a little country cottage that we, near the lake and all that. So it was a much lower economic level than, let's say, here, but there was normal life. Family gathered and people had children and grandchildren and married and led lives. But in a social and economic way, it was existence as opposed to living. And so we made a decision at some point that this system had no future, which of course it didn't, as it turned out later. But we left in 78. I guess we started this process in 77. It took us a year to get out. Got completely expropriated on the way out, had to give up everything, citizenship, all property, all money. A suitcase a person and $100 under capital controls is all you were allowed to take. And if you tried to smuggle something, going through that border, you may not end up in the West, you may end up very far, very deep in the East for a very long time. So the stakes were so high that it wasn't worth it for most people to even try taking anything out. They were cutting seams of clothes. It was like that. You had to arrive to the customs 4 hours ahead of your flight and go through a full, complete, like everything on the table, every scrap of whatever was in your suitcase or on you was on the table and examined, and questioning and all that. So those are the circumstances. of how we decided and how we left. And obviously that left an impression on me that to some extent informs what I think now about what I see or observe going around me, wherever it is I am, including right here in the United States, where I've been for 43 years.
And one of the things, it was like the first thing you mentioned in sort of the parallels between the U.S. and the Soviet Union was a loss of faith in politics, loss of faith in institutions. Can you talk a little bit about that? Because I've been noticing that myself.
Well, this is all tied with propaganda. I mean, everything in the Soviet Union was propaganda. The press was controlled by the government. All media was controlled by the government. And so the censorship of whatever people had access to in terms of official information was 100% complete. There was absolutely nothing that could make into any form of media without being run by the censorship organizations that distributed censorship that existed throughout the Soviet Union. So the information that people got would be had to be from either Voice of America or some of the foreign radio stations that were broadcasting into the Soviet Union. We were being suppressed by the technology at the time. They were being drowned out by the counter signals, so it was hard to listen to, particularly in large cities. And then, who are you going to believe? What you hear on the radio or your own eyes? I mean, every 5-year plan was overfulfilled, ahead of schedule, ahead of budget. In other words, every company beat its earnings estimates, every time, and there was nothing on the shelves. So at some point, you say, "Wait a minute, something's not connecting here." Like I'm being told that I live in paradise, and in the meantime, I'm spending 3 hours in line for toilet paper. So even though people kept saying, well, these are temporary difficulties, we're building communism, this has to, these are just growing pains. But after a while, just like here, it becomes like growing pains. I mean, I'll be dead by the time this growth is ended. So what's going on here? It's not happening. And then what happens is and this is the real problem, and it's a problem here, as the government keeps saying things, by the government, I mean generically, as authorities, keep saying things. And as some things pan out to be true and some things don't pan out to be true pretty soon, there comes a moment when people say, I don't know, I don't know which part of it is true and which part of it is not. And that's where confidence is lost. Like, you can't be 80% truthful or 70% truthful because, okay, fine. If you're a 100% liar, people will catch up to you right away. But if you're a 20% liar, it takes a while because it's all mixed with truth. And so there's always an argument. Well, maybe they didn't know about this. But eventually, when that happens randomly but consistently, you say, I just don't know. Anything they say, I have no idea whether it's true or not. Since they lie periodically, I don't even know. I don't know what to believe. And so then people start saying, well, I don't know what they're saying, but I know what I'm seeing. And that's where the big disconnect comes. And I would say that in the end, the collapse of the Soviet Union was not brought on by a revolution or was brought on by some sort of a huge economic crisis. I mean, there was a massive economic difficulty, but there was no acute crisis. It was brought on by this wearing down of credibility to the point where the elites themselves, or counter elites within the elites, said, this is all BS, it's not really working, we need to do something, and they did it. And so the collapse of the Soviet Union was a political event as a result of this glasnost and perestroika, sort of the liberalization of ability of people to come out and say what they want. And then eventually that led to a change of regime, which happened overnight. It was a political decision. And there was no particular, when we say about the collapse of the Soviet Union, there was no explosion when it happened. I mean, it happened on a Christmas night in 1991. One flag went down, the other flag went up, and everybody woke up in the new world, and then hyperinflation, collapse of the economy, and so forth. So that's kind of what gives me the creeps, if you will.
Yeah.
What I'm seeing here.
We're gonna I do want to talk about this a little bit more with respect to China later on, but let's get to the point. One of the things you emailed me, you were talking about the current conditions that we are observing are a logical outcome of globalization, financialization, and virtualization trends. So, financialization and globalization, I'm familiar with. Can you explain these for me?
So, first of all, what do these words mean? So
Yeah.
let's define them, right? So financial is let's not define the terms, but let me explain what I mean when I say that. So financialization essentially is optimizing economy to finance and asset prices. The simplest implication of that in real life we can see in the behavior of companies that borrow money, let's say at all-time low rates, to buy their stocks back at all-time high prices in order to drive them to all-time higher prices, which is fine as far as it goes, but the money that the companies are borrowing is not going into creating new product services and predictable cash flows for the future. It's basically financial engineering to reduce the number of shares and thus juice up the price. And the incentive, of course, is because the management of the company is being compensated based on stock options. And that's what it means, optimizing industry and economy around finance and asset prices. The incentives are lined up not to produce the most sustainable, innovative, long-term competitive, strong balance sheet companies, but rather short-term profitability at any cost, by any means possible.
So when do you think we made that switch?
I think that goes back to the early 90s, probably. I mean, this is something that sort of financialization of economy started probably in the 70s. During the 70s inflation, going off the gold standard and expanding the money supply, and then essentially subsidizing. I mean, this also has to do. Financialization is a tack that we took in order to solve the systemic crisis that we had in the 70s. And systemic crisis in the 70s essentially resulted in a situation where for the next 40 years, growth in the United States and in the West in general has relied unfailingly and almost 100% on increase of credit. So in other words, a portion of consumption, 70% of the U.S. economy is consumption, and consumption is being subsidized to a tune of several percent every year by borrowing money. So in other words, we're buying more than we otherwise could afford by increasing credit. And that has gone on for like 30, I guess you look back, early 80s is when this started.
I remember this was in like the late 90s. I used to read Barron's, and Alan Abelson wrote the Up and Down Wall Street column. I don't know if you remember.
I absolutely remember that. Yes.
Yeah. And he was kind of obsessed with this issue, and periodically he would post a chart of total debt to GDP in the United States, and it went from 150% to 200%. And he was talking about this concept about we were financing consumption through credit, and he basically said this is unsustainable, so it's going to crash. And now total debt to GDP is like 400%. So when does it end?
It's a faith-based initiative. It's about confidence. I mean, credit. The word credit comes from the Latin word credere, which means
to believe.
To believe. So it's a belief. It's a belief system, just like communism was a belief system. I mean, it didn't work in real life, but it was a belief system. And guess what? On the strength of that belief, the Soviets controlled the largest country in the world for 70 years. 70 years. With total BS ideas, excuse me. But... But people bought into those ideas, and then of course a few bayonets for those who didn't get the message in time got them in line. So we can't dismiss the fact that the power of ideas and power of sort of the suasion of large governments, and particularly when a large number of people are benefiting from these conditions. And who is benefiting? The people who are in the position to make decisions. The decision makers are benefiting from these conditions. I mean, the Fed governors are trading the market in front of the announcements that they make. So, when you have those kinds of conditions, it's possible that it goes longer than one could imagine. So I think the financialization started in the 80s, 70s, and 80s. I think that globalization started in the 90s. There's a great interview that I would recommend to anybody who hasn't seen it. I've tweeted about it before, from 1994 with Jimmy Goldsmith. late Jimmy Goldsmith, who was a British financier, who wrote a book, I think, called The Trap. And Charlie Rose interviewed him for about an hour about that book. And he explained in that book very coherently how this outsourcing to China is going to ruin us all. And it kind of, if you listen to that interview, it is positively prophetic. So globalization, essentially, and he explained it there, and that's what it was, it sounds like, nice, it's all bringing the world together. What the economic substance of that is importing cheap labor and cheap resources. Economically, it's similar to colonialism in a sense that the empire, the core empire, marshals resources in the periphery of its dependents or its counterparts, whatever, that it controls in some way, to obtain for the main country cheap production or cheap agricultural goods or cheap resources that are less expensive than they would be in the home country, or if the home country were buying it at sort of from a similar country, in other words, from another. Emerging markets, we call it these days. I don't know why we still call China emerging markets. It's like one of the largest economies in the world. I don't know. I think it's emerged. But that's kind of the idea. So the impact of globalization was this disinflation, which is obtaining cheap goods and producing those goods in factories that didn't have labor laws, that didn't have environmental laws, and all those costs that would have had to be borne and would be part of every little thing that we buy, little trinket that we buy, are just not there. So the trinkets have become cheaper than they otherwise would be. Now, when you pair that with financialization, which is optimization not to robustness, not to sustainability, but optimization to short-term financial results, and you pair that with digitization, which enables the whole thing. Why do I say it enables the whole thing? It enables the whole thing because you can't manufacture stuff in China and ship it here without real-time communications. You can't, because all the, drawings and everything gets emailed back and forth instantly. I mean, I happen to know this because my daughter works at a company that manufactures stuff, a consumer products company. And so I can see what they're doing and how, the conversations with the factories are real time, changes are made real time. So without digitization, without the technological revolution, that level of outsourcing would simply not be feasible or possible. Neither the same level of financialization would be feasible or possible. Derivatives. I mean, we have trillions of dollars of derivatives. We didn't have that. So the digital world removes a lot of the limitations that physical world imposes, at least in the short term.
I want to talk about globalization for a little bit. So we kind of went through this free trade revolution in the 90s. I mean, Clinton was a very free trade president. We signed NAFTA. And at the time, you had these economists, that talked about comparative advantage and Ricardo and stuff like that. And, basically, I mean, you know how comparative advantage works.
Sure.
So, we had this arrangement with the East where they exported goods to us and we exported finance to them. And that worked for a long time. So why did it stop working?
Well, I mean, we just saw what happened with COVID and with supply chains. I mean, we realize. I mean, when you optimize something to no margin of safety, it works beautifully until you need margin of safety. And when do you need margin of safety? You need margin of safety when there's a disruption of some kind. Or when something happens. So here we see COVID happen, disruption of supply chains, and all of a sudden we realize that this whole just-in-time world that we built is subject to disruption on a very global scale, basically on a global scale, and immediately, essentially. The lead times. I mean, this started several months ago, but the lead times are very short, and then you get into a big problem. So I believe that this is causing a reassessment on the part of many companies as to what their supply chains and how much inventory they need to carry and where do they need to manufacture. Beyond the companies, the governments, I mean, it discovered that, let's say, personal protection equipment is made in China. Antibiotics are made in China. I mean, a lot of things are made in China that are part of what we used to call civil defense. Sort of essential goods and services that need to be accessed or potentially cranked up in terms of manufacturing in case of emergency. And now we're discovering that the capabilities to manufacture that are not onshore; they're somewhere, and then we can't get them because we don't have enough containers and so forth. So I think what we discovered simply is a disruption like COVID has revealed the fragility and the lack of backup resource in this entire firmament that we've built on the strength of these technologies and basically leverage. That's what leverage does, right? Works both ways.
Yeah, the other interesting thing about the just-in-time inventory, so I got an MBA in the late 90s, so that was like the thing back then.
Oh, yeah, same here.
Everybody was talking about just-in-time inventories. Just-in-time inventories make sense during a deflationary environment, because if you're carrying inventories, they're losing value, so you don't want to carry a lot of inventory. You want to carry it as little as possible. In an inflationary environment like we're in right now, it actually makes sense to carry more inventories because the value of those inventories are actually increasing, and it incentivizes people to carry more inventories.
But there's another aspect to it. I mean, this whole just-in-time inventory concept came from Japan. Remember, Japan was going to defeat the world, or not defeat the world, but own the world, and the kairetsu were the way to do business and so forth. Sort of like in the 60s, the conglomerates. But in Japan, the just-in-time inventory, it's domestic industry. Of course, if it's Ford and the suppliers that are within miles of each other, maybe that makes a lot more sense. But if you're carrying just-in-time inventory, except that it's coming from 10,000 miles away, and there are 2 ports or 3 ports through which it all can come, and all the things we're seeing now, that there's a whole other angle to it. I mean, there are just physical limitations to what you can do. Yes, financially, you're right. But in terms of practical ability to manage that without disruption, it depends on everything working just so at all times. And sometimes it doesn't.
All of this results in a lot higher prices.
Yes.
Right? I mean, because what we're experiencing right now is not globalization, but deglobalization. We're reversing what's happened in the last 20 years. And, if we onshore this manufacturing and we carry these high levels of inventories, I mean, this inflation that we're experiencing it's not just monetary inflation. I mean, the Fed gets a lot of the blame, but it's actually more of that. I mean, COVID actually kind of sparked off this deglobalization, and we're going to have high inflation probably for 10 or 20 years.
No question about it, and that's what you and I discussed before we started. I wanted the point of this conversation not to be transitory, non-transitory. Therefore, what should I buy? The point is that I believe we're going through a secular shift in conditions, and that this secular shift started with the crisis of 2008. It's essentially that business model of just-in-time, globalized, cheap capital, high leverage, all derivatives. That model met its match, if you will, in the 2008 crisis. And since then, we've been carrying forth on extraordinary monetary policies, extraordinary fiscal policies, extraordinary measures to control the markets and the interest rates and the cost of money. We have not had a free market of any kind. I mean, whatever problems may have been before, they've been exponentially increased since 2008. So the last 12 years, I think, is I don't know how to say it. I mean, it's a chronic patient on life support, basically. And now we saw took another turn down with COVID. And that's why I think that we are undergoing through a protracted repositioning, global repositioning, geopolitical repositioning, geoeconomic repositioning, that will have very far-reaching consequences financially and economically, and is having it, but without sort of a abrupt end, if you will, yet so far.
So I want to get back to what you were talking about, credit and the credit cycle. Now, we had a credit cycle in the pandemic in 2020 that lasted about 8 days.
Yeah, yield spiked. yeah, spiked to like 10, 11% for about a day or two, and then that's it. No defaults, or
Yeah,
very few defaults.
The Fed started buying corporate bonds. They bought the corporate bond ETFs.
That's right.
And I actually wrote about this in my newsletter today. The consequences of that are going to extend out for decades because, the Fed has withdrawn most of that support from the corporate credit markets. So corporate bonds are free to trade lower, but it's very hard to short a corporate bond with the expectation that it'll go lower if the Fed can again come in and basically provide a put and support the credit markets again. Like, it's just, I kind of fail to see how we're going to have a real credit cycle in the next 10 or 20 years with the constant threat of the Fed stepping in and doing this again.
Well, look, the truth is nobody knows anything. We don't know. I mean, the future is unknowable and we can't know it. We know the past, we know the present. We can analyze what we see in the present and make judgments as to how sustainable, unsustainable, whether it makes sense or it doesn't make sense. But we don't know how long it goes. But we do know from history, from long history, that while what's going on today is unprecedented in its scope because of the technologies, because of the conditions, because of a lot of different things, we know that in history there were many episodes like this. They were not exactly like this. I mean, the opening line of Anna Karenina, Tolstoy's Anna Karenina, is all happy families are alike. Every unhappy family is unhappy in its own way, meaning that every crisis has its own unique features, but, we know how unhappy families end, usually in a divorce. So how you arrive there may take a number of years and different types of circumstances, but that's where we're going, I believe. So when you say for the next 40 years, okay, or for the next 10 or 15 years, so I just looked. So the yield on high yield bonds right now is about 4.4%. Inflation is running at 6%. This is high yield bonds. This is not government bonds. Forget about the fact that they're negative real return of 2% a year. What about credit risk? Well, so there's zero for credit risk. Well, I guess technically there's 325 basis points of spread from the Treasury. That's 1.5% with 6% inflation. What sense does this all make? So people say, why isn't gold going up? Well, I say, why should it go up? I mean, why aren't bonds going down? It's all part of the same thing. So my answer to all that is what is manipulated here are incentives and confidence, not the actual markets. I mean, yes, of course, the markets are manipulated, but you can't manipulate the market without manipulating confidence and manipulating incentives. You need people to want to do certain things, even though those things don't make sense. Like, is it rational to buy Shiba Inu coin? Well, on the one hand, it's irrational because it's a joke. On the other hand, it's rational because it's a tradable asset that's going up, and people want to make money on something that's going up.
And real rates are negative 5%.
And real rates are negative 5%. So, so what we are observing cannot be divorced. You cannot say, oh, it doesn't make sense, but it's going on, and therefore it will continue to go on forever. So my experience with unsustainable systems, my personal experience, is that they go on and they go on and they go on much longer than anybody thought that Soviet Union, let's say, would go, to the point where when it collapsed on a Christmas Eve, not a single foreign intelligence agency, Western Security Service, has predicted it. After predicting it, quote unquote, or expecting it for 70 years, they actually didn't see it coming. And so my answer to what you're saying is, whatever happens to stop this, we won't see it coming. We may see it coming in theory, like one day it will come, but we're not going to see it coming specifically. And that's the dynamic of bubbles. And that's why vast majority of people lose all their money. Because when do you sell? Anything anybody sells, they're sitting there biting their elbows, as they say in Russian, because whatever it is they sold is higher than it was when they sold it. So how can you keep selling and then it keeps going up and you feel like you're missing out? And that's the problem. That's the problem. So even people who are ostensibly made a fortune, most of that fortune is still, all those eggs are still in the same basket.
Well, you talk about manipulating confidence, but my career started in the late 90s, and I've seen two big losses of confidence. One after the dot-com bubble, which, by the way, people sort of forget how bad that was. It was a very mild recession in economic terms, but that bear market lasted almost 3 years. I mean, that was,
Oh yeah.
really, really tough. And of course, the financial crisis. I hesitate to say how. I mean, you said like we can't see it, but at some point in the future, we won't be able to manipulate that confidence anymore.
And it could be an event, or it could be a geopolitical event, or it may come from China, or it may come from Russia. People are not paying attention. There are significant policy changes happening both in China and in Russia, pivotal changes that may have very acute and unpredictable impact on events. And I advise everybody to follow it. I mean, these are not small changes. These are very big directional changes, which, by the way, is one reason why I don't think that China is coming back as the cheap manufacturing hub for everybody forever. I mean, they've made some policy choices there in terms of directing their own internal economy and production resources that will alter that. It's not a collapse overnight. It's just things have changed. Things are different. We are operating at a very high level of leverage to everything being the way it was in perpetuity without anything going wrong. That's the point. Nobody's taking insurance out. I mean, the markets are clearly betting that everything's fine. That's what they're betting. And if anything is not fine, that the Fed will fix it. That's the bet. Huge bet. Better not be wrong. That's what I say.
Let's talk about China for a second. So we're talking about credit bubbles, and I mean, the biggest credit bubble in the world is in China.
Absolutely.
I mean, just massive amounts of credit creation in China. It's much bigger than what we had in the financial crisis in terms of scale. A lot of people were focused on Evergrande, but not really at sort of the bigger implications of Evergrande. I mean, the whole real estate sector has at least $1 trillion market cap. So what does it look like? I mean, I had somebody say to me a couple of weeks ago, they said, everybody prints in the end, right? So is that the future for China? Like, is that how this plays out? Like, we have a massive amount of money creation in China. They export inflation to the rest of the world. It gets worse.
I'm not an expert on China, or neither am an expert in Russia. But I would say that just in my gut, based on my experience in the Soviet Union, I'm not a fan of the Chinese model. I think that when I was in business school, the same story was being told about Japan, that they have this ministry, MITI, of trade and industry that could just so regulate and tip off these big conglomerates as to what they needed to do, and that level of cooperation and direction from the government was really a perfect system that the Western decentralized system could not match. And we know what happened to them. I am not a believer that China, with its communist ideology and its, the fact that Xi Jinping is president for life, and the fact that they think that they can tweak whatever they unleashed in their sort of capitalist spurt there. They can manage all that, just that the government can come and just do a little bit here and a little bit there, and all flowers will bloom. I don't believe that. I mean, I realize that completely free markets and sort of predatory capitalism has its own issues and runs afoul of reality as well, and perhaps there's something in the middle. But what they're trying to do, it hasn't worked for the Soviets. And I don't think it works. And it's not a model for the world. I mean, at some point, leadership in the world requires some sort of an idea that people are willing to sign on to. I don't see any idea coming out of China, like compelling American idea. or the compelling Western European values that carried us through here for the last few hundred years. I don't see any intellectual capital coming out of China in that way that would allow it to do what everybody thinks it's doing. So I'm not an optimist on China personally.
Yeah, I mean, these are the questions that people were asking about China maybe 5 to 10 years ago, because their version of state-directed capitalism, state-directed investment, seemed to be working. I mean, I don't know if it was the Financial Times or one of the publications, but said, maybe this is superior to the American model. I mean, like you said, it's the exact same things that people said about Japan in the late 80s and in early 90s. And, if you think about what's happening in China's real estate sector, I mean, if you go back 2012, there was a 60 Minutes show that had a segment on the ghost cities in China.
Yes, right? I remember that.
How they were building these giant cities with no people, and they were going to move people into it. It was all state directed. And it was funny because, people watched this on TV and they were very bearish on China. And like you said, things take a long time to play out. And 9 years later, you have Evergrande, and, the whole real estate sector is, trading in low single digits. So it really took that long to play out. But it's state-directed capitalism, and it's not going to work.
It's not going to work because I think experience has shown time and time and time again that it's impossible for any central authority to calibrate something as complicated as economy for hundreds of millions of people. I mean, it's just not possible. I mean, they can be successful for a period of time. Totalitarian regimes are very, very efficient at marshaling resources on huge projects, industrialization, electrification, infrastructure build. They're very good at that. They're much better at that than free enterprise system. But to actually maintain innovation and to run an economy on a sustainable basis, that has never been done. And I don't think it's possible to do. It has to do with human nature. It has to do with the level of corruption. Corruption is directly correlated to the central control. I mean, the more permits one needs to get, the more permissions from government or sign-offs or whatever one needs to get from people who are making, let's say, $60,000, $70,000, $80,000 a year, and these people are signing on the millions and millions and millions of dollars of allocations to private companies that are going to make fortunes, whose owners are going to make fortunes. I mean, that just creates incentives that it's humanly impossible to contain. Okay, you can contain it on a small scale in a small country, but on the scale of a country like China or the United States or Russia, it's impossible. Russia has been corrupt forever because Russia has been totalitarian forever because government has controlled, even under the czars, even under the capitalist system. They controlled everything. So there's always massive corruption. So I think that this is all human, and history is very clear on that. And I think increasing the corruption in the United States, official corruption in the United States, is directly tied to the increase of the role of government in the economy, which is not to say the government should not be involved in modulating or moderating or enforcing the law or enforcing the rules of the road. But it's different from actually allocating resources and directing contracts and directing money to different places. President Eisenhower saw it coming. I mean, I've said that before. Every American citizen should read Eisenhower's farewell address that he delivered in January of 1960. I mean, or 61, I'm sorry. You have to read it. You have to read the full thing, not just about the military-industrial complex. He specifically described exactly where we are today. He specifically described the dangers of government allocating massive resources to private industry and directing those resources and the potential for corruption and malfeasance that this creates. And here we are. I mean, it happened. It happened to us. That's part of the problem. And it's happened it's systemic in China, but it wasn't systemic to our system. But we changed our system to make it systemic to our system. Because the system we have now is a different system from the American system 100 years ago, Now,
one of the things you want to talk about, I'm going to skip ahead a little bit, is the gamification of investing. So it's funny because, I have a brokerage account and I do all my trades by voice and I never use the app. And recently, I opened a Coinbase Pro account and I bought some cryptocurrencies. And I was telling people, I'm like, man, this is fun. Like this is, I mean, the technology in these trading apps is unbelievable in terms of like, analytics and looking at market depth and stuff like that. I'm like, this is absolutely incredible. Then you have Robinhood and stuff like that. So talk about the gamification of investing.
Well, unfortunately, I literally left in the other room. I had a couple of bills that I wanted to show, but that's okay. I can describe them. I have a 100 mark bill from 1910 or something like that, German marks. Great paper, engraved, beautiful engraving, real money. And then I have a bill from 1923, I think, billion marks. Everybody has seen these bills from Zimbabwe and whatever. That's not the point. The point about that bill is that the paper is cheap and not engraved, offset print, and one side is printed and the other side is blank. There's no printing on the other side of the bill. And the point is that people inherently understood that money was funny money. The same thing happened in Russia during the hyperinflation of during the revolution of the 1917. The currency was printed on rolls like toilet paper, but they were little, and they were just rolls, and you just ripped off a certain number of pieces of paper. That is a tangible signal that this is funny money. In the system that we have with digitization, there is no signal that you're dealing with funny money. No, none at all, because you're dealing with these apps where swipe right, swipe left. And therefore, at no point do we get a signal that something is going on with our money. The same thing with production of money. Now, Germany ran out of ink. The Federal Reserve is never going to run out of digits. I mean, they're, out of the computing power, so they're just pushing the buttons and creating more money, and there's no factories that are churning out this money, and the 24/7 trucks that are being delivering it, and the quality of it is bad. We don't have any of that signal. So dematerialization separates us from our ability to perceive that. Now, the other aspect of that, gamification, is okay, so go to Las Vegas. Anybody who's been to Las Vegas knows how it works. You walk in, there's a big hole, there are no clocks. It's always night, right? Every time a machine wins, and the machines are programmed to periodically win, pandemonium. Ringing lights, action, everybody runs, screams, all that, right? The excitement of games. What is Robinhood app? I mean, every time you do a trade, there are flashes, there's a fireworks, bing, 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 bing. This is the same technology. This is how Manhattan was bought for beads and trinkets. People are excited by trinkets. I mean, I'm not making light of it. That's our psychology. So the Indians were, the Native Americans were excited by these objects, manufactured objects that they have never seen. We're excited by swiping right and swiping left and seeing the flashes and all these charts popping up and the lights, camera, action. I mean, I'm not making light of it. Propaganda works. This is a form of propaganda. This is a form of influencing people's emotions, appealing to people's emotions to elicit certain behaviors. That's what this gamification does. I mean, you had to call your broker before. The broker told you, something story. Then you placed the order. Then they mailed you the confirmation. This is all instant gratification. You can be in and out of a security in seconds. And since you can be, people are. And if you make $3, bing, 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 the lights are flashing. And the thing, please, again, don't take lightly what I'm saying. This is real stuff. I mean, if you read Kahneman and Tversky about, human response to marketing and human response to ideas, this is all real stuff. Game theory, I mean, this is all real stuff. Humans are humans, and we are prone to certain types of stimuli, and we respond to certain types of stimuli. And so that industry has been leveraging technology in tapping into human propensity for instant gratification. and sort of the thrill of gaming. And so investing, which used to be providing capital, savers providing capital to enterprises to create real value in the real economy, are essentially now playing at the roulette table, with bells and whistles, and people keep winning. So of course, if you keep winning, you keep playing. I mean, why would you stop playing? Except the game is Texas Hold'em. Every next hand could take down the whole table. So everything is on the table. You know that Kenny Rogers song? Don't count your money while you're sitting at the table. All right. Well, everybody's counting their money while they're sitting at the table. That's exactly what's going on. All this money is created inside this ecosystem, and it feels real, and it is real for as long as somebody can cash out. But if God forbid, that's it.
One last thing I wanted to ask you, and then we'll finish up, is talking about passive investing. So if you go back to like 2017 or 15, 16, 17, Vanguard was gathering huge amounts of assets. They got to like 5.5 trillion of assets. And like within the financial community, there was sort of this panic about passive investing because it was growing very rapidly. And ultimately it got to about 50% of assets under management. So, and then it kind of stalled. So today, about 50% of assets is passive and the rest is active. Japan is higher. I want to say Japan is like 65 or 70%. But it's actually, nobody talks about this anymore. I mean, it's one of these subjects that just kind of disappeared. And yet, the ETF industry is still growing and growing and growing and gathering more assets. When we were on our call, I was telling you about an ETF, and you said, well, that's an algorithm. That's, and I said, no, it's actually an actively managed ETF. But talk about the impacts of passive investing and where this is going.
Well, passive investing is another form of leverage. It's basically making investment decisions not based on merits of any particular company or industry, but placing a general bet on the market as a whole, which is placing a bet that these conditions that have allowed the markets to rise indiscriminately and to have companies inside these markets that have not made money ever and yet being valued higher and higher and higher. I mean, it used to be success used to mean that the company, while private, has become profitable to the point where it can become public. And that was success. In other words, becoming public was a reward for building a successful business, because now you could sell it to the public. Whereas now, they sell the business to the public before success, and that's success. In other words, the definition of success is creating an idea that can be pitched and sold to the public, and then the proof of the pudding will come later. In other words, the profits and everything will come later. So success comes on the front end, and then we'll see what happens after that. So what passive investing to me is another exercise in leverage and dematerialization, where 50% of the market is making a directional bet that the size of the economy, the size of profits, the size of these companies, or profitability of these companies, will continue in aggregate to increase indefinitely. That's the bet.
Which is really a bet on economic growth.
It's a bet on economic growth, but it's also a bet on 5,000-year highs making new highs, right? So it's not buy low, sell high. It's buy high and expect it to go higher. That's what it is. That's the bet. Now, whether that bet is a sensible bet, I mean, it has been for people who have made it to date. The question is this a sensible bet forever? I mean, again, I don't know, but history and common sense suggest that if something is unsustainable, it won't be sustained. It's a question of when. It's a question of how, or how badly. But I don't think it's a question of whether. I think it's not an if. It's going to happen. There's going to be a reorganization. And that's where, so the whole point of what I'm saying is it's not that we're going down the oceans. I mean, down underneath the water. What I'm saying is that there has to be a major reorganization of balance sheets, of claims, of financial claims against real assets, and that reorganization will produce winners and losers. Passive investment is not set up for that. Passive investment is set up macro, all winner. And when you have 50% of the market that suddenly is not performing and needs to sell, the question is to whom? To sell to whom? To the Fed? That prints more money? I don't have answers to these questions. I don't think anybody does. So people just assume that somehow it works out. Now, I'm not in the investment business. It's important to understand. I'm not in the investment business. I'm not predicting any trades. I'm in the insurance business. I picked, to be in physical gold because I don't want to make these bets. Because I wanted to find something that's outside of this world that can sit there and exist independently, and then one day potentially be a resource, or become a resource, a reserve that can be deployed if these arrangements don't work out. It's like you have your fire insurance because if the house burns down, you can't afford that outcome. But people essentially are selling their fire insurance because they think that the premiums that they save can make them more money in the market or in crypto or in some other place. And so now they're all in and there's no insurance. Okay. I mean, there are people who do that and maybe they'll get away with it. I don't think so, but history doesn't think so, or there are no precedents for that. But, people think it's different this time. And they always do think that's different this time. And in some way, see, the problem here is in some ways it's always different this time. It's not like it's never different. It's always different. But in a big sense, it's not. So the details are different. Yes, every tragedy has its own specifics. Bull market is just, everybody wants to know why prices go down. Nobody ever asks why are prices going up. Have you noticed that? Nobody's pounding the table.
I ask why prices are going up.
Well, you do, and that's your business. That's why you have a letter that people want to read. But I'm saying that, nobody's pounding the table at MSNBC demanding an explanation as to what the hell is going on. Why are these prices going up? Nobody does that. They take it as a given. Well, it's good prices going up. They only ask when they're going down. Well, I think it's important to know why something is going up. You may be surprised in the end if you don't know the answer up front. So I think that's the issue, and that's the point. And so we have levered everything to a particular outcome with no margin of safety. That's what I see as a problem, as a huge problem. And that's why I think a lot of people are going to end up getting hurt, because it's a very strong pull of these profits and of this market and of this gamification, bing, 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 bing. That's my view. But, I'm not saying I know the future. I don't know any better than others. I'm just trying to be prudent. And I think people who are in a position to lose a lot have to think about it.
Yeah. That's a good place to stop. Simon, thanks for the interview. This was awesome. I really liked it. I really liked talking to you.
Pleasure.
And I hope to see you on Twitter. Hope to see you around. Get to talk again sometime.
For sure.
Thank you.
Very good. Thank you very much. Great talking to you.
See ya.
See ya.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.